So the buyer actually puts the money into the trust or buys the asset from the trust. It's a three-party transaction. Smoke clears. Buyer got whatever he was, bargaining for, right? Matt gets a promissory note, and the trust holds the capital.
Now, I want to circle back to your thoughts and some of the conversations you're having around 2024 being one of the best buying opportunities that we've seen in a long time. But walk us through the mechanics of something like this, right? I think a lot of people understand the mechanics of a 1031 exchange. You sell your property, you've got gains, you can defer those gains by finding another asset, meeting all the criteria of a 1031 exchange, and getting that done, like you said, in 180 days, right? Now, what does that look like from an A to Z standpoint on a deferred sales trust?
Yeah. So step one is you set up a trust, and these trusts are no cost, no obligation trusts where you can have it in place as an option. And we're going to weave this trust into a contract. And that contract basically states that, let's say Matt's the seller. Matt has the right to a 1031 exchange or a deferred sales trust at no additional cost to the buyer. So we're not surprising the buyer at the close of escrow. And what's happening is, let's say Matt has a $10 million asset in which he's owned for 27 and a half years. He's fully depreciated the property. It's multifamily in California. So if he were to sell, he's got about a $4 million, tax bill. And so instead, he's like, I'd like to have the option to assign the rights or sign the interest of an LLC or the equity at close to this trust in exchange for a promissory note. And we know this is a seller carryback, right? Where IRC 453 allows an installment sale method of selling where Matt can become the bank. And in that scenario, at the close of escrow, Matt receives a promissory note for 10 million and an interest rate, let's just say, is 6, 7, 8, or 9%, depending on your risk tolerance. And what happened was, you go, where did the cash come from? Well, the buyer was already lined up for 10 million. So the buyer actually puts the money into the trust or buys the asset from the trust. It's a three-party transaction. Smoke clears. Buyer got whatever he was, bargaining for, right? Matt gets a promissory note, and the trust holds the capital. Okay. Which, if you think about it, this is kind of like a 1031 exchange in some respects. What happens in a 1031? Well, instead of the funds going to Matt personally at close, it goes to this third-party qualified intermediary. And as long as Matt follows the rules with the QI company, he can have the 10 million transferred to another asset and deferred. Well, in this scenario, we're just not going to use the 1031 exchange laws. We're going to do 453 installment sale laws, and we're going to put it into this trust. And that's where the magic happens. Now Matt can invest into T-bills making about 5%, or money market making 4%, or hard money lending making 10%, which is what we've been doing for the last couple of years because we weren't doing the 1031s. We were making about 10% on our money. But more than that, you can partner with the trust and go buy more assets. And so really the big step is just getting it in place, getting the planning in place, and getting the option language in place. And oh, by the way, this works for businesses and cryptocurrency and stock, not just investment real estate. It also works for high-end primary homes. Whereas the 1031 exchange is just a small little box of investment real estate, which is part of why that's Blockbuster and we're Netflix.